How do you find those really rare stocks, the ones Peter Lynch made famous, the true multi-baggers that, multiply your investment many times over? It's sort of the holy grail for so many investors, right? That dream of turning a relatively small sum into a significant fortune. Today, we're taking a deep dive into exactly that. We're looking at an empirical investigation into these exceptional market performers. We're dissecting a recent 2025 working paper by Anna Yartseva, and it's very aptly titled The Alchemy of Multi-Bagger Stocks. Our mission really is to unpack the real quantifiable characteristics and drivers behind these multi-bagger stocks. We want to challenge some perhaps widely held assumptions you might have and equip you with actionable insights that are rigorously validated by data. No guesswork here, just evidence. So, okay, let's dig into this. Despite all the intense investor interest in finding the next big winner, traditional financial analysis often struggles. It has a hard time pinpointing future stock market outperformers. It's common frustration, I think, trying to sift through all the noise out there.
And that's precisely where this study shines a light, actually. Because, surprisingly, rigorous academic research on multi-bagger stocks as, like a distinct group, has been quite limited. Most of our collective wisdom, it's come from seasoned investment practitioners. Think legends like Peter Lynch, Thomas Phelps, Christopher Mayer, Ramdale Oswald. Their insights are invaluable, of course, but they've largely been heuristics based on experience and often lacking that systematic empirical validation.
Right, more rules of thumb than hard data sometimes.
Exactly. And prior research also had some significant limitations. Many studies relied pretty heavily on anecdotal examples, maybe just a few success stories, or they were more descriptive rather than truly analytical. They often used subjective criteria, like judging wise capital allocation, which is, well, incredibly difficult to measure before a stock takes off, right?
Yeah, how do you quantify that beforehand?
Precisely. And crucially, most of these studies only covered periods up to about 2014. This means they completely missed an entire decade of just monumental shifts in financial markets. Think about the explosive growth of disruptive technologies like AI, gene therapy, blockchain, and, I mean, a barrage of major macroeconomic and geopolitical shocks: Brexit, the COVID-19 pandemic, surging inflation, interest rate hikes, global conflicts. A lot happened.
A completely different world, almost. And that's where this study makes its unique and very timely contribution then.
Yes, exactly. It directly addresses these gaps by using robust econometric methods, basically, advanced statistical techniques to provide a quantifiable, evidence-driven framework. And the research zeroes in specifically on the recent 2009 to 2024 period in the U.S. market, which gives us a much more relevant snapshot of today's investing landscape.
Okay, so tell us about the data they used. What exactly were they looking at?
Well, the study's data set is pretty comprehensive. It's an empirical analysis of 464 enduring multi-bagger stocks. These were listed on major American exchanges, the NYSE and NASDAQ. And what defines enduring? Each of these stocks increased in value by at least tenfold. That's 900% gain between January 1st, 2009 and January 1st, 2024. And crucially, they maintained that level. Companies that maybe briefly hit multi-bagger status but then dropped below that threshold were intentionally excluded. They wanted persistence.
Makes sense. And the time period, 2009 to 2024, why that specific window?
The rationale for choosing that period is quite deliberate and I think powerful. It starts right at the market low following the 2007-08 global financial crisis. So it essentially resets the market, if you will, ensuring the focus is on companies and characteristics relevant to the current environment. Plus, this 15-year window captures an incredible range of market conditions: 2 recessions, subsequent recoveries, periods of both rising and falling interest rates, multiple bull and bear markets, and all those global shocks we just mentioned.
So it's a really representative period.
Absolutely. It's a truly representative period.
Okay, so to begin cracking the code, the study first applied the traditional FOMA-French 5-factor model to this unique sample of multi-bagger stocks. Now, this model is a standard in finance, looking at market risk, size, value, profitability, investment patterns. But given how unique multi-baggers are, did applying this traditional model immediately reveal some surprising insights? Or was it more of a starting point?
It was definitely a starting point, but yes, it immediately threw up some fascinating and at times quite surprising patterns when applied specifically to these multi-bagger stocks.
Okay, like what?
Well, let's start with the size effect.
Yeah.
Generally, small-cap stocks were the champions here. They clearly outperformed medium and large companies. Small companies, those with a market cap below $250 million, they achieved an impressive average annual excess return of 37.7%.
Wow, that's huge compared to the others.
It really is. Contrast that with 14.5% for mid-sized firms, which averaged around $2 billion, dollars, and only 9.7% for large firms, averaging $32 billion. Dollars. But and it's important to remember this, small cap alone isn't some kind of silver bullet. The study found that within small companies, some specific portfolios actually led to losses for investors. So it's not just about size, it's about, what else is going on under the hood.
Right, nuance is key. What about the value factor?
Next, the value effect. This was quite clear too. Companies with a high book-to-market ratio consistently generated superior returns. That's where the book value of a company's assets is higher than its market price, often suggesting it's undervalued. These high-value portfolios delivered an average 34.7% annual excess price return. In stark contrast, low-value portfolios, those indicating overvaluation or sometimes even negative equity, they only generated about 12.8% and in some cases led to actual losses.
So fundamentals still matter, even for these high-growth stories.
Absolutely. This strongly reinforces that strong fundamental value is absolutely crucial, even for stocks you hope will grow massively. And then there's the profitability effect. Robust operating profitability was another clear and consistent driver. Portfolios with strong profitability generated significantly higher excess returns compared to those with weak profitability. We're talking, for example, 40.9% versus 28.5% for those high-value companies. The study specifically highlighted that companies exhibiting weak operating profitability were strongly associated with negative actual price returns.
So avoid the money losers. Seems obvious, but the data backs it up strongly here.
It does. If you're looking for market-beating performance, avoiding companies that consistently lose money is, well, paramount. Now let's talk about the investment effect, because this is where traditional wisdom gets completely upended.
Oh,
Huh.
how so?
Well, the original FAMA French model from 2015 suggested that aggressive investment tends to lead to lower future returns. But this study found the exact opposite for multi-baggers. For these exceptional stocks, controlling for other factors, aggressive investment, meaning higher year-on-year asset growth, consistently led to higher average returns.
Really? Higher returns from more investment?
Yes. This pattern was observed across all comparisons within the study's sorts. It strongly suggests that for multi-baggers to truly outperform, they don't shy away from investing aggressively in their future growth. In fact, it seems to be a prerequisite.
Wow, that is genuinely surprising. Okay, so it sounds like while the FAMA French model offered a good starting point, maybe gave us some clues, it still left a lot of the multi-bagger magic unexplained. You mentioned this intercept term earlier. It sounds like it had a big blind spot. What exactly did that mean for trying to find these stocks, and what did the researchers do next?
Yeah, you can think of it like this. The FAMA French model gave us a map.
Right.
But the intercept term was like this huge blank spot on that map where all the treasure, all the unexplained multi-bagger growth was hiding. It basically meant the model couldn't explain why these stocks were growing so much beyond those standard factors.
So you needed a better map.
Exactly. We needed a new, more detailed map. So the researchers developed a more sophisticated, upgraded model. They used a rigorous general-to-specific approach, starting broad, and then systematically refining their insights based on the data.
And what did this upgraded model find?
Well, one of the first things they uncovered was that certain financial metrics were just better proxies for understanding these specific companies, sharper tools, if you like. For instance, total enterprise value, or TEV, which includes the company's debt, proved to be a more effective measure of a company's entire footprint, its true economic size, than just its market capitalization.
Okay, that makes sense.
And similarly, price to earnings, PE, replaced book to market as an initial valuation measure in this context. And EBITDA margin replaced operating profitability for predicting future returns. It seemed to capture something more meaningful for these growth stories.
So refining the inputs. What else?
Following on from that investment insight, they uncovered a really unique investment pattern. It built on the earlier finding. While aggressive investment is indeed beneficial for multi-baggers, here's the crucial nuance. It must be sustainable. It has to be supported by corresponding earnings growth, specifically EBITDA growth in their model.
Ah, so not just growth for growth's sake.
Precisely. They introduced a new variable, a kind of flag, that triggered when a company was expanding its assets at a rate exceeding its EBITDA growth. And what they found was, frankly, alarming. When a company expands its assets faster than its earnings can keep up, the stock price return for the following year tends to be about 22.8 percentage points lower.
Wow, a huge penalty for unsustainable growth.
A huge penalty. This isn't just about investing. It's about smart, sustainable investment. That link to profitability is key. And building on that idea of profitable, smart growth, they uncovered what was arguably the most important driver of all:
Okay, the big one.
free cash flow yield, FCF over price, or FCFP. This was identified as the single strongest predictor of multi-bagger stock outperformance. The study found a really strong positive relationship between a company's free cash flow yield, how much cash it generates relative to its market price, and its future share price return.
So cash is king, even for growth stocks.
Especially for these stocks, it seems. It highlights that strong, unencumbered cash generation is just a paramount signal. Macroeconomic conditions also play a pretty significant role, as you might expect.
Right, the wider environment.
Yeah, the interest rate environment, in particular, significantly affects these multi-baggers. When interest rates are on the rise, this environment tends to depress their returns. It lowers next year returns above the risk-free rate by approximately 8 to 12 percentage points.
And the logic there is?
It makes sense when you think about it. Growth stocks often rely heavily on promised future cash flows, right? So they're naturally more sensitive to changes in the discount rates used in their valuation. Higher rates mean future cash is worth less today.
Got it. Okay, so we have size, value, profitability, smart investment, free cash flow, interest rates. What else?
And then we come to what is perhaps the most counterintuitive finding of the lot: complex momentum effects.
Momentum. I thought momentum usually helps stocks.
Well, that's the common wisdom, but here it's different. The study revealed that multi-bagger stocks exhibit very rapid trend reversals. It's like they have a very short attention span when it comes to price trends. While maybe, just maybe, 1 month momentum showed a slight, short-lived positive effect, and only in one model version, both 3-month and 6-month momentum effects were found to be significantly negative.
Negative. So if it's been going up for a few months, it's more likely to go down next year.
That's what the data suggests for these specific types of stocks. If a stock had been on a hot streak, growing consistently in the preceding 3 to 6 months, it was actually more likely to decline in the next year, according to this analysis. And adding to that, they looked at the price range variable, basically, how close the current stock price is to its 12-month high. That was also negative, meaning the closer a stock's price is to its 12-month high, the lower its next year's price return tends to be.
That completely flips the script on buying high flyers near their peaks.
It really does. These technical findings strongly align with something called the overreaction hypothesis, which suggests markets tend to overreact to past news, both good and bad. For multi-baggers, this implies the ideal entry point is absolutely critical. The stock should ideally be close to its 12-month low at the time of purchase, and ideally, it should have fallen considerably in price in the preceding 6 months. It's like buying a great company when it's temporarily and perhaps excessively out of favor.
Wait a minute, let me get this straight. You mentioned profitability was key, and EBITDA growth supporting investment. But you're telling me that earnings growth itself, the #1 metric for so many investors, the thing every analyst obsesses over, was found to be insignificant in predicting future multi-bagger returns.
No.
That seems, well, truly counterintuitive. This section sounds like it directly contradicts some really deeply ingrained investment beliefs.
It's an absolute shocker, isn't it? But yes, the study found that earnings growth, and they tested it in all sorts of forms: EPS, sales, gross profit, operating profit, net profit, cash flow, both year-on-year growth and longer-term 5-year cumulative growth rates. None of them were statistically insignificant in predicting future multi-bagger returns in the dynamic models.
Wow. Just insignificant.
Insignificant. It simply didn't stand out as a reliable predictor once other factors were accounted for. And the study also found that several other factors commonly thought to be crucial were not supported by the evidence in the dynamic modeling either. This included things like a company's level of indebtedness and its overall financial soundness metrics like debt-to-capital ratios or Altman Z-scores, various solvency scores. They didn't predict future returns reliably.
Even things like buybacks.
Yeah, most capital allocation decisions like debt increases or reductions and even share buybacks were found to be insignificant in predicting future capital appreciation for these stocks. Now, dividend yield did show some significance in the simpler static models, but it wasn't a primary driver in the more sophisticated dynamic models, which implies that while, yes, multi-baggers can provide dividend income, the study showed 58% paid dividends in 2009, growing to 78% by 2024, that dividend itself isn't what drives their explosive capital gains.
So dividends are nice, but not the main engine.
Exactly.
Yeah.
Interestingly, even the author's own custom variable, this R&D propensity measure, which looked at R&D spending relative to free cash flow, was not supported as a predictor of higher share price growth either.
Okay, so a lot of commonly held beliefs didn't hold up under scrutiny for this specific group of stocks, but how well did the models actually predict future performance?
Ah, good question. Let's talk about the predictive power because it's pretty impressive. They used data up to 2022 to predict what would happen in 2023 and 2024. And these estimated models accurately trace the direction of market change for the overall multi-bagger portfolio. They correctly forecasted both the portfolio's decline in 2023 and its subsequent growth bounce back in 2024 with remarkable accuracy.
That's pretty good.
It is. And what's really cool or maybe reassuring for investors is that the models systematically underestimated the actual returns. They were consistently a bit more pessimistic than reality, predicting lower risk-adjusted returns than what was actually realized, especially when interest rates were stable or falling.
So they undershot the gains.
Yes, on average, the forecast error was negative, around minus 6.6%, meaning the reality was better than the prediction. This is actually a positive feature for an investor, right? It gives you a kind of built-in margin of safety. The models basically err on the side of caution, providing a conservative estimate.
That's actually quite useful. Now, this whole finding, the fact that observable fundamental characteristics and recent stock performance can apparently reliably predict future returns for these stocks. Well, this raises an important question about market efficiency, doesn't it? It seems to explicitly challenge the efficient market hypothesis, or at least the strong form of it.
It absolutely does. This finding strongly suggests that the U.S. stock market, at least for this segment, does not fully or perhaps immediately price in all publicly available information. It implies that market inefficiencies can be identified and potentially exploited to achieve abnormal returns. So in essence, it validates both fundamental analysis looking at value, profitability, cash flow, and technical analysis looking at price patterns, momentum reversals, entry points as valuable tools for investors. It suggests there are genuinely exploitable edges out there if you know where and how to look.
Okay, so pulling it all together for you, the listener, the core takeaway from this deep dive seems to be that the alchemy of multi-baggers isn't just about finding companies with raw growth potential. It's about a much more specific, maybe even nuanced blend of fundamental strength, valuation, and quite precise market timing that actually goes against some conventional wisdom.
That sums it up well. And just to reiterate those key actionable insights for potentially identifying future multi-baggers, based on this study, focus on small-cap companies. Look for high-value characteristics, especially a high free cash flow yield. Robust profitability is essential. Critically, while they must invest aggressively, remember that crucial caveat. This investment needs to be supported by commensurate EBITDA growth, no runaway spending. And finally, that entry point seems paramount. Ideally, these stocks should be bought when they are near their 12-month low and had experienced a significant price decline in the preceding 6 months. Buy them when they're down, not when they're soaring.
It's a fascinating combination of factors. So here's a final provocative thought for you to consider. Given how this rigorous empirical study overturns some really deeply ingrained investment beliefs like the absolute necessity of strong earnings growth and revealed these counterintuitive technical patterns like the rapid momentum reversals, it makes you wonder what other investment truths that you might hold could be worth re-examining through a new evidence-based lens. The market is always evolving, right? And sometimes, well, what we think we know isn't quite the full picture.